Ladies and gents, traders and investors, a very warm welcome to our channel Polo Vega. On today's video presentation, which is our 50th anniversary presentation, we shall be continuing with the option spreads. But what we're going to talk about is different from what we talked about in the last couple of weeks. During our earlier discussion on spreads, we were referring to front and back as different months, which was the current month of trading of options and futures, or the month after, which was the back month of trading of futures and options. In case of ratio spreads, which we're going to talk about today, the front ratio spread refers to the collection of credit upfront or profit upfront, and the back ratio spread refers to the collection of profit at a later stage, which is basically a debit strategy. Over and above the discussion of ratio spreads, we shall also be visiting the charts of US dollar, the Dixie, XAU/USD, the gold based ETF, XAG/USD, the silver based ETF, NQ, Nasdaq based ETF, ES, which is the S&P 500 based ETF, and of course US oil spot, which has seen a resurgence in price after the resumption of the war between America and Iran on Wednesday. We still have to grapple with the fact that our trades are going to get affected by the ongoing tension between the United States of America and Iran. Therefore, our stop losses have to be absolutely tight, and we need to be always careful of a change in the direction of trade that we've speculated before entering into a trade. Disclaimer/disclosure. The contents of the presentation are for information purposes only. The material has been obtained or derived from sources believed to be accurate, but we do not guarantee its accuracy. The presentation is the 50th of a series of interactive videos aimed at educating our viewers, and we would like to warn all our viewers of the risk associated with the business of trading and investment. Securities trading and investment is a highly risky business, and there exists a possibility of total/partial loss of investment. The ideas and opinions in our video are solely based on our analysis of markets, and we do not advise, guide, recommend anyone to take any trade based on the contents of this video. We do not take any responsibility for partial/total losses arising out of trades based on the contents of this video. Traders and investors, the chart on our screen is that of Dixie, the US dollar index, and we're looking at the daily chart. As discussed last week, we could see that the resistance which had turned support at 100.391, it's still acting as a very good support, and Dixie has been bouncing off this area for the last 1 week. Although there has been a resurgence in the oil prices, gaining more than 10% during the last 3 trading days of the week, we can see that it's now had an appreciable effect on the Dixie. The Dixie has managed to print 2 red candles on Wednesday and Thursday, followed by a green candle, but it's still hovering around the area of 100.391, and one needs to see if it manages to break below 100.391 in the forthcoming week, or does it get an additional impetus from the rising oil prices to get into the old supply area between 101.077 and 101.887. But still, that's speculation, as Dixie trades sideways when it should have jumped up under the influence of the rising oil prices. The chart on our screen is that of NQ, the Nasdaq based ETF, and we're looking at the daily chart. NQ printed 2 red candles on Monday and Tuesday, followed by 3 green candles on Wednesday, Thursday, and Friday. However, the close of Friday is the same as the close of Monday, which is about 30065.93, and one needs to wait and see if it manages to continue printing green candles to go up, or whether it comes back into the demand area underneath the current low of 28 or 2900, and if it can manage to bounce off this area, or whether it breaks down below 27995. However, there is not much of an impetus to push NQ in any direction as we speak, and one needs to have a clear idea of the impact of the loss in the AI stocks vis-a-vis the change in the oil prices that occurred last week. There is a geopolitical influence on the ongoing trades in NQ, as well as the impact of the loss in value or revaluation of the AI and tech stock, which has been going on for the past few weeks. So the effect of these two seem to be nullifying each other, and the index is trading sideways at the moment. The chart on our screen is that of ES, the S&P based ETF, and we're looking at the daily chart. ES seems to be doing better than the NQ, with printing a new high as compared to the close of last week. It is currently trading at a place between the previous high and the all-time high, which is between 7587 and 7688. It needs to be seen if it manages to break above the previous high at 7688 during this week, or whether it comes back down where it can find a nice support area at around 7539 with a stop loss going below 7457, or further down one can see a demand area between 7447 and that of 7369. However, because of a continuous release of news that could impact the movement of the index in any direction, one needs to be very careful with their stop losses while going into a long on this trade or on this index. The chart that we see on our screen is that of US oil spot, and we're looking at the daily chart. US oil spot managed to bounce off the demand zone between 66.67 and 63.36 this week, which was on Monday, Tuesday, and Wednesday. So therefore, the bounce off from the demand zone was not directly under the geopolitical news coming out of the resumption of the war between United States of America and Iran. It was the drop was first influenced by the signing of the peace deal between the two countries, and then the further drop occurred partially under the influence of the strength gained by the US dollar index after the Fed meeting there, where the rates were kept steady and no dot plots were announced by the Fed chair Walsh. But no matter what the news is, we can see that US oil spot has been following the technical levels of both demand and supply, and as of now we see that after bouncing off the demand area between 66.75 and 62 point or 63.0, it has come back to the previous demand area which it had broken. So there we can see that demand is turned back into supply, and it has managed to come back down all the way from 75 to 71.15. So there is a response to the technical levels over and above the influence of the geopolitical news on this asset class, and one needs to keep their stop losses absolutely tight, whether we're going into a long trade or whether we're going into a short, depending upon the trend, whether it's sideways, whether it's upwards, or whether it's downwards, along with the news generated momentum into the trade. The chart that we see on our screen is that of XIU/USD, and we're looking at the daily chart. It is the gold based ETF, and it has been bearish since April 2026. It managed to print its last high at about 4400, and then it came down to 3975. Last week it printed some blue candles, but it could not break above the 4200 level and finally closed at 4110 on Friday of this week. So the bears still seem to be in control, and there are no long trades as we speak. We need to see the establishment of a nice demand area with an explosive move out of the area to support any more long trades that the bulls want to get into. As of now, there is a small demand area between 4027 and 3940, but it's not very strong. It is basically a bounce off from the area of 3983 and 3870, which was printed in October last year. So that's the demand zone that is in play, and we need to see if it manages to stop it here, or whether the metal breaks below the area of 3451 and 3261. So that's the demand area that one could see the bears targeting if at all it breaks below the current demand zone. The chart on our screen is that of XIG/USD, which is the silver based ETF, and we're looking at the daily chart. Silver is been completely lackluster during the last 2 to 3 weeks after losing nearly 50% of its value since the high that it reached in January, which was at 121.75. The new low that we saw was at 55.64, and we wouldn't be surprised if it makes further lows and further highs, going down all the way to maybe anywhere between 3900 or 39.00 to 29.00, or even lower, because as of now we do not seem to find any buyers or any bulls supporting the metal, and the last few trading sessions have seen the metal lose a lot of value, but this week it managed to bounce all the way up to 63.9 and then come back down and close at 59.84. Therefore, the moves in silver are relatively quite explosive, because in terms of percentages it's moving by about 10 to 20% each week, either up or down. There could be some good profit making trades coming into play, but we need to wait and see the metal enter into a nice demand or supply area. As of now, we don't see any strong demand zone formed anywhere near the current price, but there is a nice supply here at about 69.44, and we could look at putting a stop loss at 71.70 or slightly above that, and coming back all the way down to this area of about 58.0 as a target. And with our discussion on ratio spreads where we left, we just want to define ratio spreads as those option strategies where we either purchase a single call or put option and we sell two or more short options, either call or put. So the options are always of the same type, either a call, which becomes the call ratio spread, or put, which becomes a put ratio spread. Most popular of these ratio spreads are the front ratio spreads, where we go short on two options and we go long on a single option. The strategy is based on a high volatility or a high implied volatility market where we expect the price to rise quickly. There is a financing of the debit trade that we incur while going long with the second option or the third option that we may buy, where the ratio becomes 3:1 in place of 2:1 to fund the purchase of the long option, and the maximum profit occurs when the underlying is at the short strike price. In case of the back ratio spread, we are going long on two options once again, either call or put, and we go in short on a single option. So again the ratio is 2:1, or we could go long on a higher amount if we are confident about the speculated direction of the trade. So it could be 3:1 or 4:1, but here, since we are buying more number of options of the similar type, we are going into a debit, as the credit from the short doesn't cover the full price of buying the long options. We shall first talk about the front option, the direction, the IV, and the profit and loss from the trade. Let's now define the front call ratio spread. The front call ratio spread is based on a neutral to bullish environment, and we go long on an ATM call option and we go short on two or more call options which are OTM. The shorten of the call options gives us the credit to finance the purchase of the single long option. We are collecting a credit or a profit upfront by getting into two or more shorts and one singular long. Again, the environment is of a high implied volatility, and we expect the price to inflate at a rapid state, and that's how both the premiums are inflated, those of the shorts OTM that we sell and those of the ATM long that we buy. we are basically short delta biased, or we would like the price to move downwards, in which case both the long as well as the short option expire worthless. There is also a chance of making a profit if the price of the underlying moves in the upward direction, and the maximum profit occurs when the price of the underlying is at the OTM strike price of the shorts that we go into. But if we start moving above the OTM strike price, then we are going into an undefined loss. Why? Because we've got one long to cover one short that we had got into, but the second short remains open, and if the price of the underlying moves above the OTM strike price, then we continue to lose as long the short does not expire in our favor, which is below the strike price that we entered into. Talking about the front put ratio spread, once again, we shall now go long on an ATM put option and then go short on two or more options depending upon the amount of credit that we want to get upfront. Once again, the implied volatility of the market is high, and now we are neutral to bearish in our speculation. This trade is basically a long delta bias, and it profits if the underlying moves in the upward direction. Again, like the front call ratio spread, the front put ratio spread as well is omnidirectional in its strategy. Why? Because we profit from both the upward as well as the downward movement of the underlying, and we don't go into a loss until the underlying goes below the strike price of the shorts that we go into. If the underlying moves upwards, then both the long as well as the short expire worthless, and we've got our profit from the credit that we collected. If the underlying starts moving downwards, we get the maximum profit when it is at the strike price of the shorts that we entered into, and then our risk becomes undefined or limitless when the underlying crosses the strike price of the shorts that we go into, because one of the shorts still is uncovered because we've got one single long and we've got two or more shorts. So as many shorts that we buy, except for the first short, all the other shorts are uncovered, and we could lose endlessly if the price happens to fall below the strike prices of the shorts that we entered into. We now talk about the back ratio spreads, which are nothing but an inverse of the front ratio spreads. In these ratio spreads, we shall be buying or going long on two ITM call or put options and going short on one OTM call or put option. Once again, we are dealing in the same kind of options, either call or put. The IV at the time of entering the trade is required to be low or as low as possible for the premium to be cheap, because it's a debit strategy, as the credit received from the show is not sufficient enough to fund the premium spent in buying two or more options. Therefore, the strategy believes in a sudden expansion of volatility, or there is an expectation of a news coming out which could allow the volatility to suddenly expand, and there could be a price swing in our expected direction, and that's how the two longs can give us an indefinite amount of profit. Here the loss is limited and definitive, which is the amount of net premium that we were debited while entering the trade, and the credit that we shall receive from the longs going in our direction give us an infinite amount of profit. Defining the back call ratio spread, what we do is we go long on two ITM call options or more long on call options and one OTM short on the same call options with the same expiry day, but this time the show is at an OTM. So therefore the premium received for the show is lesser than the single long premium paid to get into the debit trade. Since it's a ratio trade where we buying 2:1, 3:1 or 4:1, so the number of longs are much more than the short, and therefore the profit potential from the trade is unlimited, while the loss is limited to the net debit that we pay at the time of getting into the trade. Once again, the direction is neutral to bullish, and we expect the underlying to move in the upward direction. It's got a long bias. Compared to the front call option, the back call ratio option trade has got a long bias, and we profit from the underlying swinging up in the upward direction. This strategy, being a debit strategy, is not a preferred strategy by most traders, as those who are not in love with spending money upfront. Coming to the back put ratio spreads, we go long on two or more ITM put options, and then we go short on an OTM put option with the same expiry date. Here we profit from a downward movement of the underlying, or the strategy has got a short delta bias. Why one gets into this kind of a strategy is because of an expectation of the market or the underlying crashing suddenly from a normal implied volatility to an extremely high implied volatility condition. So it's neutral to bearish, and when we are getting into the trade, we expect the implied volatility to be low so that we pay the least amount of premium to get into the trade, and then we expect the price to swing downwards, giving us an indefinite amount of profit. Once again, it's not a very popular strategy because most of the ratio traders are not in love with paying an upfront premium or going into debit before looking at a profit from the intended direction of the trade. The loss occurs when the underlying starts moving upwards and the long expires worthless, when we lose all the premium that we have paid to get into the trade. Before we come to an end of our discussion on ratio spreads, we must look at the impact of the effect of volatility skew. Volatility skew refers to the different prices of equidistant OTM calls or puts, depending upon what the market expects and which direction does it expect the underlying to go towards. The premium is either overpriced or underpriced depending upon the inclination or the speculation of the market bias. If the market expects the underlying to crash because of some incident that could occur in the near future, then we shall find the OTM put to be having a higher price as compared to the equidistant OTM call option. Or otherwise, if the market expects the price of the underlying to move upwards for some reason, then the premium of the call shall be higher as compared to the OTM equidistant put option. Usually, under normal circumstances, we find the price of the call premiums to be higher than the equivalent or the equidistant put options. Therefore, there is a chance of collecting a higher premium from the shorts that we get into in case we go for a front ratio spread, and if we know that the premium is going to inflate in a certain direction, then the ratio strategy, either the back ratio spread strategy or the front ratio spread strategy, can be more profitable for us, and our spread between the OTM and the ATM could be wider for the same amount of money spent for getting into a back ratio spread strategy. So do not neglect volatility skew while getting into a ratio spread trade. We now come to the end of our presentation on ratio spreads and our commentary on various events and incidents from the previous week. We shall continue with our discussion on option spreads once again in our next video presentation, where we shall talk about the broken butterfly spreads, which are a kind of combination of vertical spreads as well as ratio spreads. But before we go on to our discussion on these spreads, we would like you to go back and watch all our videos on different kinds of spreads. We hope that our videos have been informative and exciting enough for you to come back and watch all our videos. If you like them, please hit the bell icon underneath and subscribe to our channel Polo Vega. You may also visit us at our website www.polovega.com or get in touch with us through our Twitter handle @PoloVega. We wish you all the very best for the forthcoming week, and we shall advise you to trade very carefully and with absolutely tight stop losses because of the impact of the news coming out of the war between United States of America and Iran, and also between that of Russia and Ukraine. Please trade carefully up until such time that the geopolitical situation normalizes. We thank you for watching all our videos, and please like, share and subscribe to our channel Polar Vega.